Yeah, so my name is Mike Pettingell. I'm the president and CEO of Vizsla Royalties. I'm a geologist and an engineer by background. I've worked at pre-producing and producing mines as well as in the capital markets as an equity analyst for a number of years. What we have here is incredibly special at Vizsla Royalties. We are a single asset precious metals royalty holder, with our flagship asset being a net smelter return royalty, or an NSR, covering Vizsla Silver's flagship Panuco project down in Mexico. We've got about 6,000 hectares of coverage. We've got a 3.5% NSR and a 2% NSR covering various concessions that I'll get into here momentarily. We are trading on the Toronto Venture Exchange under the ticker VROY, as well as in the US on the OTC QB under the ticker VROYF. I will be making some forward-looking statements today. So this is a pretty simple investment thesis. We like to say it's a threefold investment thesis. We do have this tier one silver gold royalty covering arguably the world's largest, highest grade undeveloped silver primary resource in Mexico, which is Panuco, Vizsla Silver's project. They just published a feasibility study earlier, I guess it would have been last month, a few weeks back. And that really just confirms what was stated in the PEA published in 2024 and builds upon that. Frankly, highlighting a material growth in economics, de-risking those early years and producing significant amounts of silver and gold over this initial 10-year mine life. Now it's become a bit of a permitting story as the project is fully financed with feasibility out. Permits were submitted in February, and the expectation is those permits will be received sometime in the first half of 2026. This puts Vizsla Silver on target to first pour of silver and gold in the back end of 2027. And of course, Vizsla Royalties stands to benefit greatly from that production decision. So when you think about this threefold investment thesis, you've got, a development story that's continuing to grow and de-risk, with a rising commodity price environment. So there's ways to win on operational upside as the project continues to progress forward through development and into production. But also there's so much exploration upside remaining in this vastly underexplored district. You can see on this slide here, Vizsla Silver's only really tested a handful of its known targets. It's only mapped about 70% of this district, and this district is the size of the island of Manhattan, right? It's huge. And where the mine plan sits today is really just a small postage stamp in the corner. In fact, Vizsla Silver's map sampled a cumulative 93 kilometers of vein strike, whereas the mine plan, owing to Vizsla Royalties, really only covers about 8% of that. So lots of targets still remain to be tested, and new discoveries certainly can be made. So you've got the development upside, and then you've got all this exploration upside in and around the mine area, but also in the district as a whole. And then when we talk about timing, right, there's an absolute scarcity of quality silver primary assets in the world today. In fact, there's only 14 billion ounce silver districts on the planet, full stop. And we've got all the hallmarks here at Panuco to become, the 9th in Mexico and the 15th globally. So we're very excited about this potential given the quality of this asset. But also when you look at this backdrop of record-setting commodity prices mixed with recent precedent transactions in the royalty space, it really does bode well for some of these single asset royalty companies in terms of an acquisition multiple. So, although we're incrementally growing and we get to realize the operational and exploration upside as Vizsla Silver continues to de-risk and explore where we don't have to outlay any capital or dilute, combined with, of course, these recent precedent transactions, there's multiple ways to win on this file. So what is Vizsla Royalties? It is a single asset royalty holder, but, the genesis of it is a spin out directly from Vizsla Silver. And so in January of last year, we spun out this royalty portfolio privately. It consisted of a 2% NSR royalty covering the Rio Panuco concessions, And these are more of your exploration concessions. And I've got a map that I'll show on the next slide here. And then it consisted also of a 0.5% NSR covering the Silverstone concessions, which really does make up the bulk of the proposed mine plan in not only the PEA, but of course the recent FS that was published. Vizsla Silver also spun out a ROFR, so a right of first refusal on any new royalties for new properties that it may acquire over the next 2 years. So that does provide us with incremental growth that we can continue to tap into, essentially following the mothership, so to speak. As they pave the way, we can follow them and pick up their breadcrumbs. Now, the spin out went directly to shareholders, and that's important. This wasn't, paid to the company. This was for every 3 shares that you held as a Vizsla Silver shareholder, you would have received 1 share in Vizsla Royalties. It also, big difference that we did between some of these other single asset royalty spinouts is Vizsla Silver retained a 45% ownership in the company. That's since been diluted down to about 17% on a fully diluted basis. So it is still a meaningful block in terms of what Vizsla Silver can use to fund ongoing exploration and development at the Panuco project. Now, in August of last year, we listed the file. We listed under the Toronto Venture Exchange under the ticker VROY. It still consisted of that same, call it 2% and 0.5%. Now, it's important to note that on that 0.5% ground, those Silverstone concessions, there was a third party that held an underlying 3% NSR royalty. Vizsla Royalties had a buyback right to purchase half of that royalty. So in June of this year, we went and we raised $40 million US to one, exercise that buyback right, but also negotiate for the other half of that underlying 3%. So we negotiated for that full 3%, paying them $40 million. That completely transformed the net asset value owing to Vizsla Royalties. We now have a 3.5% NSR covering 95% of the proposed mine plan, and that other 2% covers the remaining 5%. So we cover 100% of the mine plan. We ended up more than doubling the net asset value here, dramatically growing the discounted cash flows owing to Vizsla Royalties. So here's a map of those principal assets that I discussed. So you can see here all these light green concessions. That's covered by the Silverstone. So that's where we have the 3.5% NSR. You can see that covers 100% of the Copala structure, which really is the backbone of the Panuco project, is where mining will initiate. Frankly, it's a 10-meter wide, on average, structure. It runs for 1.8 kilometers currently in total strike length. But just like every other structure in this mine plan, it's open in every direction, laterally along strike and vertically at depth. But even that, you can see, it's still covered by, as you marched along strike, you're still covered by that 3.5% NSR. And then all these dark green concessions, predominantly, as I mentioned, off in the east, really covering the exploration ground, but it does cover a bit of the northern end of Napoleon. That comes in later in the mine life. But again, you are covered, the royalty package covers 100% of the proposed mine plan that Silver has published. So for those of you that don't know the district that well, I think just doing a quick overview, Vizsla Silver, they own 100% of this district. So they're not encumbered by any third parties. The only royalty holder here is Vizsla Royalties, which, of course, there's extreme alignment given it as a direct spin out from Vizsla Silver. It's located in western Mexico, about an hour drive from the coastal city of Mazatlan. Mazatlan's got about 1 million people in it. You've got excellent infrastructure here, deep sea port, rail that runs the coast. You've got an international airport there. You can fly in from any major city in the world. And you've got a highway. It's about an hour drive, as mentioned, that bisects the district. That highway is an added security bonus for us here in Mexico as it connects the central part of the country with the coast. And as such, it's a major thoroughfare that is maintained by the government and the military. So it is an added bonus in terms of security. You also have high tension power. Now, this is arguably the most important and sets us apart from some of our peers. When you talk about access to power, that's been one of the largest impediments for Silvercrest and Mag Silver to actually reaching initial production. It was that access to grid power. Where we sit here with the proposed mill site, if you look above you, the high tension power, a 240 kV line runs directly over top. So we absolutely have phenomenal access to infrastructure here. And following the feasibility study, we're continuing to de-risk, but we are absolutely advancing very fast towards production to capture this commodity cycle that we're in. To support this, we've got a fully permitted, fully funded test mine that commenced last December. We are down now about 500 meters down the ramp, approaching the sample location, and that sample location is actually basically into year one of Copala production. And the real strategy here is for Vizsla Silver to de-risk in advance of making a mining decision, and of course in advance of getting those official mine permits, so that by the time those permits come in, well, Vizsla Silver's already underground and they can just continue mining day one and stockpiling mineralization. The real strategy, as mentioned earlier here, is to decouple the mine startup risk from the mill startup risk and really ensure that you've got the feed required for this brand new hungry mill, right? And again, ultimately, all of this is to target first silver in the back end of 2027. As mentioned earlier, there is significant exploration upside. Vizsla Silver with a laundry list of targets. I think they've got about 165 drill-ready targets to date. That's less than 30% of the known targets they have. They've got 4 drill rigs on site now, spinning, testing extensions to known mineralization, as well as testing some new areas where if there is exploration success, could absolutely bolster the economics that I'm going to highlight here shortly in the current mine plan. And lastly here, Vizsla Silver is very well financed, and that's great. Why is that important for Vizsla Royalties? Well, when you've got a well-capitalized operator or developer here, it does put you in a good position to ensure you'll realize those cash flows in the time frame that you expect. So Vizsla Silver currently has $480 million in financing capacity. This represents over 2 times what the initial capital outlay is in the feasibility study that was stated just last month. So in a very, very strong position financially. So the resource growth cannot really be understated here. And this really is important for Vizsla Royalties and its shareholders. Really what we're showing here is the trajectory of growth. Vizsla Silver every year, essentially since that maiden resource, they drill 100,000 meters roughly, and they add 100 million ounces of silver equivalent. That was really the pattern, and you can kind of see that as we go through the years here. But when we go into a mining scenario in a feasibility study, you need to have very high confidence in that resource. So we do that through tighter spaced drilling. And once you have tighter spaced drilling, call it sub 25 meter centers, plus you add economics, that's where you can state proven and probable reserves. Now, proven and probable reserves come out of your measured and indicated, and that's what you see here in the opaque chart, these opaque bars. Whereas these more transparent bars, that's your lower confidence mineralization inferred classification, that it just doesn't have the drill density. It's not that it's stranded or is of lower grade. In fact, in certain areas, it's higher grade than the resource or higher grade than what went into that proven and probable reserve statement. So there's lots of conversion potential here alongside the growth that continues to occur. And so I often like to think about it as you're breathing, right? You're expanding and you're contracting. So you're expanding the growth, and then you're de-risking through infill drilling and contracting and gaining confidence. And so Vizsla Silver's done a phenomenal job over the years, continuing to grow and contract as it gets to that mining decision. But it's important to note, 162 million ounces went into the feasibility mine plan when you've got a resource base of 365 million ounces. So, there's almost 200 million ounces of inferred mineralization in here that's waiting to be converted, or brought into a mine plan in the future, that can certainly have a knock-on effect to not only Vizsla Silver's economics, but of course, in turn, that owing to Vizsla Royalties. And so here's another glimpse of this resource, really just showing you the spatial distribution here, particularly of the structures, but also of those classifications. You can see the structures themselves. They're all contained within a really nice footprint here. In fact, the mine area, the surface layout proposed is only a 3-kilometer radius. This really keeps the area of influence low in terms of your permitting, but also it keeps your CapEx and your OpEx low in terms of development and hauling, right? Everything's contained in a nice footprint. Now, when you look at the classification distribution here, the hot pink is really what we were focused on last year. Between the PEA and the FS, well, we completed about 60,000 meters of drilling and announced a resource update here earlier this year in January of 2025, highlighting that conversion potential. We, in fact, converted 43% of this resource into that higher confidence category. And almost more importantly, we converted it at a higher grade, at a 5% higher grade. That's really highlighting that this inferred mineralization is not low grade. In fact, some of this mineralization was closer to surface than the current resource, outboard of the previous stope shapes, at a higher grade. So this is really what transformed the sequencing of those stopes relative to the PEA into the FS. So again, you can see all this blue mineralization that's around Copala, and particularly Antojitos here, where mining will start. And that is all that inferred mineralization that we can tick off. In fact, there's about 25 million ounces of inferred mineralization just right around that northern end where those hot pink magenta blobs are located at Copala, that we intend to start converting starting this year from underground. So here's the mine plan that was proposed in the FS that came out just a few weeks back. Relative to the PEA, we're doing a lot more production earlier on in the mine life. And of course, when you consider the time value of money, you are pushing forward the present value of those cash flows, which ultimately do wonders for your economics. So what we're doing now is 20 million ounces over the first 5 years. If you compare that to the PEA, it was 20 million ounces for the first 2 years. It then in the PEA dropped down to about 15 million ounces over the 10-year mine life, where we're seeing here about 17 and a half. So you did push forward that production profile. We saw the all-in sustaining cost creep up slightly from about $940 per ounce processed up to $1060. So still very much in line. In fact, all the parameters for this study, the throughput at the mill, the truck size being used, the locations of the surface infrastructure, the cost assumptions are all very much in line. The only real deltas that went into this study are the newer, higher grade resource that we just talked about, but also this more favorable commodity price backdrop that we're in. The PEA was stated at 1975 gold and $26 silver. So we've got a pretty big delta in terms of what we're using now at 35.50 silver and $3,100 gold. The reserves, in fact, were stated far more conservatively than the study itself as well. The reserves were stated at the same price as the previous resource that we published in January, and that was stated at $2,300 gold and $28.50 silver. So, you've got run room here beyond what is in this study, to just on paper, some triggers or levers that you can pull that will likely be changed as we move from, today, this initial study, through mine updates before that production decision actually occurs. A, with that conversion drilling, and B, with this reserves being priced far more conservatively than the study itself. The initial CapEx, very much in line, as already mentioned. In the PEA, it was 224. Now it's 239 million US. So again, very much in line. We saw the payback period here reduced dramatically down. We're now at 7-month payback period. And the overall NPV here is $1.8 billion after tax NPV5 with 111% post-tax IRR. So truly outstanding economics in this project. I should say, if we talk about in terms, because this is all for Vizsla Silver, if we talk about it in terms for Vizsla Royalties and the cash flows or the production profile owing, I said that the 3.5% covers about 95% of this mine plan. If to do simple back of the envelope math, one could just say, okay, 3.2% of all of this, right? That's one way. But if you wanted to get into the weeds, it's a 3.5% for all the Copala, Tahito stuff. And you can see Napoleon mineralization. It does start to trickle in year 2 as we develop. And then year 4, it really does come online. Now, when you talk about that production profile owing to royalties, it's about 550,000 ounces of silver equivalent per year owing to royalties, right? And in terms of cash flow, depending, of course, on what commodity price assumptions you're using, the consensus deck that we use at Vizsla Royalties, it's highlighting around $40 million US discounted in those first few years. And over the life of the project, it's averaging about $28 million. That's pretty outstanding, especially when you start to consider how royalty companies are valued close to production. And then once into production, it's on a cash flow multiple. And frankly, right now, it's about averaging 15 to 20 times that annual cash flow multiple. So you can start doing that math yourself and say, oh my God, well, there's a strong re-rate potential. As Panuco is de-risked and put into production, both files stand to re-rate handsomely. Now, we talked about this. I just wanted to break it down a little bit more. Again, this is really important for Vizsla Silver, but you get confidence in knowing that your underlying operator has the financial support to actually take this project into production, and you can realize those cash flow multiples when you expect to in the back end of 2027. So again, we'll just round up $240 million US is what the initial capex is. Vizsla Silver sits with just over 200 million currently in the bank. Following the convertible note offering, they just closed just shortly after the feasibility study was announced. That gives them another 240 million currently in the bank. And then with its equity positions, namely its position here in Vizsla Royalties, it's got another 40 million that it can use if it decides to sell the block. Now that narrative was a bit more important, I think, when it didn't have this convertible note offering secured. Where it would use potentially the Vizsla Royalties block to fund ongoing exploration and development. That's not as pressing today as it once was. So that allows Vizsla Royalties to focus more on growth strategy in terms of acquiring new assets in and around the Panuco district, where it certainly has a competitive advantage. Just looking a little bit closer at that proposed mill and proposed surface layout, you can see the mill here. It's located right in the center. I'm not sure if you can see my cursor, but you've got those high tension power lines, those orange lines there that run directly over top. I mean, you could not ask for a better location here to build a mine. All of this infrastructure is located on previously disturbed ground, which really stands to benefit that expedite the permitting horizon in front of us here. But also you can see here where those 3.5% and the 2% royalties are covering. Again, the green here, that's all covering the 3.5%. As mentioned, 100% of that monster Copala structure, whereas you do have a bit of the 2% covering some of Napoleon, mainly the northern end of Napoleon, where we do see an uptick in base metals. Now, we're not focused on mining base metals, but that just stands to show that the grade is reduced. And you can see visually on this map that the overall thickness of that structure is reduced as well. You also have a little coverage on the La Luisa structure, which comes in later in the mine plan as well. Now, that's just that one area, right? And what we were just looking at really is covered by this small blue hashed polygon in the western area of this project map. As I mentioned earlier, every one of these structures, I think there's 11 structures that make up that resource base there. Every single one of them is open in every direction. So there's lots of room to still drill and expand. And as I mentioned, that conversion drilling that we'll start, testing underground this year. That's part of that expansion and conversion potential that exists within that hash polygon. But outboard in this blue ellipse, we call this the proximal zone or near mine targets. These are these targets that, if you have exploration success, can be hauled directly to that proposed mill and have a direct effect on future economics in future mine updates. So we are drilling actively 2 targets at the Vizsla Silver side within that proximal target zone. The San Peter San Jack is a new corridor that was identified through geophysics earlier on this year, as well as this intersection of Colorado Napoleon, where we have the potential for the Copala structure, which could be a continuation of Colorado, converging with the Napoleon structure, which in a structurally controlled environment, which is what we have here, that's where you can have zones of dilation or zones of pooling and have really big areas of high-grade mineral. So that's what we're focused on, following those structural corridors and chasing where we do have crosscuts or zones of convergence. But also, we've got all this other ground that you see to the central and the east. As again, I mentioned, this is 14 kilometers long by 7 kilometers wide. It's a very large property package. It's about 7,200 hectares that you see here just on this map. We made a novel discovery in the beginning of the year here in March at the Animas target. Now, this Animas discovery, you can see it down here, 6 meters true width, grading 900 grams per ton silver equivalent. This is a world-class intercept. In fact, it was 2 intervals in one hole. And what you're seeing here, this represents the first interval, so the higher, closer to surface interval that we intercepted. Now, this discovery was made in between historic workings, below the water table, the exact same strategy and thesis we used to discover Napoleon. Use historic workings to vector to new mineralization, down dip, down plunge. More importantly, the intercept was all precious metals dominant. We had very low to negligible base metal values. Now, this indicates to us in the geology team that we are higher up in this profile. Typically, the way it works is you've got higher gold to silver ratios when you're very shallow. You can even have visible gold. Then you get into the precious metals rich core, where you have that uptick in silver and a slight introduction of base metals. And then as you get deeper, higher pressure, higher temperature, that's where you really have that uptick in the overall, influence of the base metals. So lead, zinc, in certain areas we see copper, and copper is a very high temperature, high pressure metal. And so for us to have all precious metals, it indicates to us that we have quite a bit of runway at depth to continue exploring, to continue growing the potential of this target here. So now when we look at this development timeline, because this is obviously what's important here, we look at all these check marks have been completed, right? Where we sit now is right around, Christmas here in 2025, where we've got the feasibility study out. Now, it becomes that permitting story, and where we feel we'll get this permit, and this is through the statutory timelines that Semarnat, the governing federal body in Mexico, has been following, as well as our communications with the government. They don't view this project as a greenfields build, a brand new build. They view it as a continuation of the 450 plus years of mining history that's been undertaken in this region. So again, we don't view it as a matter of if, it's a matter of when, and when we believe we'll get that permit is sometime in the first half of 2026. As I mentioned, Vizsla Silver will already be down at that test mine location and have extracted a 10,000 ton sample. At that moment, they'll have two levels already in place, and they will just continue mining the entire time that the site is being developed and the mill is being constructed, so that by the time the mill is turned on in Q4 of 2027, it's the intent to have 550,000 ounces on surface, 550,000 tons on surface. That would represent about 10 million ounces of silver equivalent, because it's about a year's worth of, or half year's worth of production that they'll have. And remember, you're doing just over 20 million ounces per year for those first 5 years. So this is really that strategy to stockpile that mineralization into high grade and low grade bins, so you can commission this mill effectively and really ensure that you've got that payback on hand to pay the project, the facility back. So the management and board very much aligned with that of Vizsla Silver. I mean, as you can imagine, it was a direct spin out. So Mike Connert, he is the founder, CEO of Vizsla Silver. He is our executive chairman at Vizsla Royalties. I am a senior vice president at Vizsla Silver. I'm also the CEO of Vizsla Royalties. Simon Smirlik, he's our COO and director at Vizsla Silver, but he's our lead director here at Vizsla Royalties. And then when you look at the other group, there's a lot of Inventa Capital employees that work on this file. And now Inventa Capital being the private parent umbrella to Vizsla Silver, Vizsla Royalties, Vizsla Copper. It's our incubator vehicle here that we use. Frankly, it does not invest in the companies itself. It really does serve as an incubator model. So shared back office services, shared accounting, different management teams, and again, it supports with corporate development to find projects and put management teams to those projects. They're focused on the commodities the world needs for the electrification push. There's about 6 to 7 companies under the file or under the umbrella that are publicly trading, and another, call it 4 to 5 that are private, looking to go public. And so Grant Tanaka, he's our CFO at Vizsla Royalties. He works on the Vizsla Copper file, as well as a few others in the Inventa umbrella. Carlene, similarly, she was at Vizsla Silver employee number 1, but she does HR for the Inventa group, as well as for a few other one of the Inventa Capital companies. And then Keith Bodnerchuk, he's the CEO of Kosa Resources. That's our uranium file in Inventa, and he supports here as a director at Vizsla Royalties. Lastly, we have Matt DeGaro, and he joined us most recently. He stepped down from his role as managing director and head of CIBC's mining group here in Vancouver. He's been involved with tremendous amounts of M&A in the precious metal space, but also notably in the royalty space. He supported Great Bear Royalties, selling to Royal Gold. That would have been back in 2023. So he supported Vizsla Royalties on the capital raise and the acquisition that they made for that NSR. He's really our back-of-pocket banker, and he's an excellent addition, particularly at this stage of the company when we're looking to do the next push for the file. So when we look at Vizsla Royalties cap structure, we've got just under 80 million shares outstanding, fully diluted. Just over $300 million Canadian market cap. We are trading very well. Really, the volumes and the liquidity really picked up in June, and you can see that on this bottom chart denoted by these blue bars here. That really picked up following that acquisition, because we raised capital, we issued shares. As you can imagine, these shares were very tightly held because it's the same shareholder base that silver has, right? Which is predominantly institutional. And you can see that on this top pie chart here. We are about 45% held by institutions. But that liquidity allowed new shareholders to get in and allowed more trading of this file. It is still very tightly held. I have more brokers and traders calling me and asking where the blocks are than there are for those that are trying to sell this file. I think individuals understand how special the Panuco asset is and how rare tier one silver royalties are in the space today. So we have coverage from three quality analysts, Carrie at Canaccord, Craig at Raymond James, and Cosmo at CIBC. Now, when we look at that position by Vizsla Silver, I mentioned this earlier, 17% held. It still is meaningful, but again, recall, following the convertible note financing, the project is fully financed. And so that the need to draw down on this block is not as pressing as it may have been prior. So when we look out at the space and we look at where our peers are trading, on a PNAV basis, you can see pretty clearly that when we look at those smaller royalty companies, and there's been quite a bit of M&A in the space. In fact, there's a few on this list that I'm looking at right now that are no longer around. Sandstorm is no longer around, acquired by Royal. You've got EMX that's no longer around, that merged with Elemental. So you've got some of these groups that are already starting to make these acquisitions, and there's been a few acquisitions that are not on this that have been made by the likes of Triple Flag, Franco, Wheaton, all of these bigger boys. But what you're seeing here is that there's a notable increase in this PNAV multiple in terms of the acquirers and those that are the potential takeout candidates. Right now, you're just seeing a 40% increase. But more importantly, when you drive into those respective portfolios of these, call it, companies that trade over $10 billion valuations, they can pay over 2 times NAV and still have at least a Vizsla Royalty portfolio be accretive to their respective portfolios. And that's really important when we look out at who might take out a Vizsla Royalties, because there is an expectation in the market that Vizsla Royalties will be acquired, just like the likes of the Triple Flag acquiring Origin. Right? This was very similar. This is one of those precedent transactions I mentioned where you've got a single asset royalty holder. They've got a 1% NSR on the Silicon project that they sold for $343 million to Triple Flag earlier this year. Now that was a pre-PEA stage, right? And so to land at that true valuation is more difficult. So we have to use the analysts and the bankers who worked on that file. And fortunately for us, we know Raymond James, we've got a good relationship, and we've got a good relationship with National. Those were the two companies or the two banks that worked on this file. So we landed at this 1.8 times acquisition multiple based on their work. Now, similarly, when we go and look at the file that Matt DeGaro worked on, well, this was Great Bear Royalties being acquired by Royal Gold. Now, this one was a 2% NSR, similar to what we have, a little bit less, that sold for 200 million Canadian. Now, this sold pre-resource, so even harder to value and earlier to value. But again, we were fortunate enough to be friends with CIBC and Canaccord, who were the opposite banks that worked on this file. And that was priced at a 1.4 times P, price to net asset value ratio. So when you look at those and you start talking about, well, what's the average multiple? Where we're trading today, we are trading well. So is the rest of the pack here. But it's showing here that we're trading at around a 1.4 times. Great Bear was transacted at a 1.4 times, Origin at 1.8 times. Yes, we can look at the average there and say it's a 1.6 times, or we can say, well, Vizsla Royalties being, the only tier one silver primary royalty that exists in the space today that is not held by one of those big three, Royal, Franco, or Wheaton. You can see that this is certainly deserving of a premium. So we can say it's a 1.8 to even a 2 times potential here in terms of that acquisition multiple that we can realize. Now, that's just one angle. As I mentioned, there's still the angle here of exploring, de-risking the production angle and acquiring incrementally from new assets in and around that Panuco district, especially given that ROFR. So really, to conclude here, there's those three ways to win. It's the development upside as Vizsla Silver continues to de-risk and heads towards that production decision, ultimately targeting first silver in the back end of 2027. You will see more conversion drilling. You will see more discoveries made. And then there's also that exploration upside that exists well outboard of that mine plan, notably the Animas discovery. And one thing I didn't mention, that Animas discovery, it sits on the 3.5% ground. So that's very beneficial for Vizsla Royalties. We don't have to outlay any capital. Vizsla Silver's got a very, very strong balance sheet. They can go and drill, and every incremental success that they have at the drill bit provides immediate torque to Vizsla Royalties and its shareholders without, outlaying a single dollar, right? So we're in a very good position here with a tremendous operator that's well capitalized to drive this forward. And then, of course, we've discussed the timing here, the scarcity, the commodity price backdrop, and with these recent precedent transactions, there could be a significant acquisition premium ahead of us here at Vizsla Royalties. So, you can see it here, the right project at the right time, led by the right people here. And it's a really, really simple story.
Thank you for the presentation, Mike. Could you tell us a little bit about yourself and your career?
Yeah, absolutely. So I'm a geologist and an engineer by education. I also have a degree in economics. I spent the earlier part of my career in exploration geology, working for pre-producing and then ultimately producing mines, covering gold, silver, lead, zinc. I've worked in open pits and undergrounds. All right. I then went back to school actually to get a master's in mining engineering, and then found myself working in the capital markets in equity research. So I worked at one of the global firms covering the junior precious metal and explorer developer space. I then came on to cover Vizsla Silver, and then joined the team very shortly after in a management capacity.
Excellent. What's your equity position in Vizsla Royalties as CEO?
Yeah, in terms of percentage wise, I probably own around 1% of the outstanding shares. My share position on common market is less than my incentive positions in terms of PSUs, RSUs, and in that regard.
Could you tell us a little bit more, what was the rationale for spinning out essentially Vizsla Royalties or creating Vizsla Royalties, and also were the royalties already, you obviously bought the Silverstone concessions, but the royalty that you started with, was that already in place or did you create that?
No, that's a great question. So when we came into the district on Vizsla Silver side, there was an underlying royalty owing to part of the property package, about 60% of that original contiguous district. And that was covered by a 3% NSR royalty owing to a private Mexican family. It did come with a buyback right, however, for half of that underlying royalty. So what Vizsla Silver did, and they did it privately, back in early 2024, they spun out, they created a 0.5% NSR covering that same ground that had the underlying 3%. And then they created a 2% NSR covering all of the other Rio Panuco concessions that didn't have any royalties owing to them. And if you go back and look at the history of Vizsla Silver and their, trajectory, the initial discovery was made at Napoleon in the southern portion of that structure that we've identified to date. That was originally covered by that 2%, right? And so the focus was, well, we've got a 2% covering, what we've discovered so far, and we'll put this 0.5 on the ground that's already encumbered. Now, you're aware of obviously the presentation that we just talked on, that was ultimately spun out and then, listed and then transacted on, particularly with respect to that exercise of the earn-in agreement, or the buyback rather, as well as we negotiated for the other, 1.5%. Bringing the total, all royalties that exist in that district now under one umbrella, right? And so to your earlier part of your question, what's the rationale for all of this? Well, it was quite simple. It was provide exposure to this asset to shareholders in the long term, especially in the eventuality that Vizsla Silver is not the operator, right? We know that scarcity of tier one silver primary assets on the planet are very real. There's not a lot out there, not a lot of quality, high grade ones either. But when you talk about that scalability, that's what's of most interest to the likes of the majors, right? The ones that want to get in there, sink their heels in, realize economies of scale, and then produce from this area for 50 to 100 years. We know that we do have a target on our back over at Vizsla Silver. And, I've expressed to you in the past, and other, management at Silver's expressed in the past, we have no desire to sell. In fact, we've built legal moats around the company and the asset for the past 2 years to really prevent that call it premature takeout. But that always was, one of the main drivers: provide long-term shareholders with exposure to this asset in perpetuity, right? That was one. The second one, because Vizsla Silver retained that percentage ownership, 45 initially, now been diluted down to 17%. It was always viewed as an optionality tool for Silver to continue exploration, to continue development on a non-dilutive basis. Now, as mentioned, in the presentation, that's less as important and pressing today, given the completed convertible note financing last month, where Vizsla Silver now has, $480 million in financing capacity at their fingertips. The call it $30 to $40 million block that they own in Vizsla Royalties is less as important in terms of optionality. And they don't need to sell it to continue funding, that development and exploration. So really, it's pushing forward revenue or value that wouldn't otherwise be realized until 2028, when the royalty was actually cash flowing. So by spinning this out and listing it publicly, we've created $300 million worth of value, frankly, that wouldn't have been realized until the asset is in production.
So then, from Vizsla Silver's perspective, you own 17%. You have ample liquidity, both fund exploration and fund building the mine. Do you see yourself selling shares next year, or what is your plan for your shareholding, and what could cause that? And if you would sell, how would you do it?
I don't know any shareholder that has a desire to sell either file, particularly Vizsla Royalties.
I meant from Vizsla Silver's perspective, if they would, as a company, sell part of their equity stake in Vizsla Royalties.
Well, and that's part of it. They're no exception. In fact, if you were to say Vizsla Silver, they know the asset better than anybody, right? In the market, right? And so for them, they have the utmost confidence in not only the merits of the project as it stands today, but the upside potential that exists at not only the development front, but of course the exploration front within that contiguous initial property package covered by Vizsla Royalties. So they see Vizsla Silver and its net asset value trading today at, call it, 0.6 price to net asset value ratio, seeing where the average producer trades at over 2x. Well, you've got a material runway there for silver alone, whereas royalties will handsomely appreciate alongside as Panuco is de-risked. So as Vizsla Silver being, the most knowledgeable investor in Vizsla Royalties, they would have no interest in selling until that production decision, and call it 1 to 2 quarters of production, is under the belt, where you can start valuing the royalty file on a cash flow multiple. I'm sure your listeners know very, very well that a royalty company, as it gets closer and closer to production, and of course, once you're in production, well, you're not valuing it on a simple discounted cash flow model with a NAV number anymore. Now you're using cash flow multiples, and the cash flows on average, based on consensus pricing that we see today for royalties, I mean, you're talking about 28 million US discounted per year. And in those first few years, you're doing over $40 million US discounted. So the average multiple today, as it stands, is about 15 to 20x cash flow. So you can start to see where this stock could be valued at if you are applying those multiples. But of course, the underlying asset has to be de-risked. It has to have permits. I mean, it's already financed, which is excellent. That's one major de-risking hurdle. But then it has to actually build, construct, and get into production to get that multiple. Vizsla Silver has high confidence that that will be able to be achieved in the timelines that are stated.
What's the cash position or financial position of Vizsla Royalties, and what's the G&A burn rate?
Yeah, the burn rate is very, very low. Our cash position is steady because of that low burn rate. Right now, including our VAT receivable from the transaction for that underlying 3%, we've got about $7 million. And then our burn is about $65,000 a month. It's very, very low. We are evaluating, but it's mainly desktop reviews at the moment. And frankly, given that we have that right of first refusal on any new acquisitions that Silver makes, we're really looking at, call it incremental claims that are not covered. And just remember that the contiguous district that Silver has now grown to that just the contiguous original one is 7,200 hectares, where our coverage is only 6,000. So just in that initial property package, we can incrementally grow. And these are the types of things we're looking at in the near term. We also have, of course, other opportunities that we're evaluating more broadly. But frankly, right now, in this part of the season, we're pretty sleepy, and we've got $65,000 burn. There's 3 guys on payroll. It's basically legal and accounting that we're paying.
So barring a new acquisition, you won't need to raise money next year?
No, I don't see us raising capital right now. Barring, to your point, barring any material acquisition. And you have to remember too, Vizsla Royalties, given that cash balance, we don't have a credit facility that we could tap in to go and make a big chunky acquisition. It's a very competitive space right now. You've seen the royalty companies kind of do a consolidation period. A few of them are no longer around. You've seen the crypto company Tether make novel investments into quite a few of them, of the smaller junior cos. And you've seen these valuations double in the past, call it 4 months. And so when you see that, the access to capital, the market capacity grows for those respective files, and they can then tap in and make broader acquisitions. That's not necessarily the case for a single asset royalty holder that's a direct spin out, right? We are not the traditional royalty company in the sense of a financier, where we're outlaying capital at a very early stage to hope and pray that we'll get that IRR back in 5 to 7 years, right? That's not really ever been our strategy, and frankly, I've always said I don't think we'll be able to be competitive in those marketed sales process. But again, we're not looking to raise capital at all right now. We certainly could go out. We have excellent, strong shareholder base and strong coverage from the capital markets. But no, that's not our interest, and we have not identified an opportunity in terms of corporate development that would warrant that.
Okay, that's good. So let's talk about your previous acquisition. You raised 63 million Canadian. You bought the Silverstone concession at 3% NSR on, among others, the Copala, which is the crown jewel, for 40 million USD. Could you talk about that acquisition, motivated value, and also the timing for it?
Yeah, absolutely. I'll just go backwards. In terms of timing, I would have liked to have that done and dusted in advance of the PEA, right? Before the PEA came out in 2024, it would have been fantastic to have transacted on this. Dealing with a private group, it does take a little bit more time. And so we weren't able to get it done there. We did want to get it done before the feasibility because, again, that puts another value stamp on the asset. And so we really wanted to negotiate this in advance of that. And we were successful, obviously, in doing so. In terms of the structure of that deal, we had the buyback right for 1.5% of that 3% NSR, and we paid $2 million for that, $2 million US. So incredibly accretive when you talk about that buyback, right? But we wanted the full piece, right? And they knew that was an incredibly accretive piece. And so we did have to pay up for that other 1.5. So in a sense, $2 million US for the 1.5, $38 million for the other 1.5. One was so incredibly accretive and one was dilutive and as our math looked at the time. Now it doesn't look like it, but at that commodity price environment, last year, one was dilutive, one was so accretive that combined they were accretive, and so ultimately we issued all shares. About to call it 35 million shares were issued for this. The deal price was at $2, slight discount to where we were trading at the time. But the NAV more than doubled, right? And so you saw the value. I think the cash flows at the time were roughly $6 million per year, right? Discounted. And that went up to roughly $18 to $20 million per year. And then, of course, with the FS, I just quoted those numbers. On average, you're $28 million a year, right? So at the time, again, creative dilutive, but you ended up adding significant liquidity and more than doubling the net asset value of the underlying asset.
Excellent. Is there any part of Panuco that is not part of your royalties?
Yes, and that alludes to that 7,200 hectares. So you've got about 1,200 hectares. Most of it's contained in the northeast, right, part of the district, where frankly Vizsla Silver has done very limited work. And it doesn't have any royalties on it. But you're starting to talk in that area that's got the 2%. If Vizsla Silver were to create new royalties, I think that's the vein it would be in. It wouldn't be a 3.5%. 2% is usually the call it the higher end of tolerability for investors. Then you start to say, hey, am I stealing from the value of the operator, right? And that was actually bringing that point up. That was actually a point that the analyst community made when we actually did this spin out from Vizsla Silver, and we had some investors that were worried that we were taking value from the mothership, so to speak, Vizsla Silver, and just transferring it somewhere else. And those long-term shareholders, some of them voted no, on the spin out, but that was all wrong. Both files, Vizsla Silver and Vizsla Royalties, went up considerably on the day of that spinout and have not gone backwards since, frankly. So it was creating additional value and pushing forward value that wouldn't have been realized, right? And so that's the way we like to think about it. You do have some investors who are a little sour on it all, but at the end of the day, no, we pushed forward value, we created value. Even at that 3.5% level.
Late 2027, you should have first silver, and the first, full year of commercial production should be in 2028. What do you view as the biggest risk that could delay that?
The biggest risk right now for the Panuco story, and I'll just change it to say the Panuco story because that affects both companies, is permitting. Right? We become a permitting story. With the feasibility out and the project financing secured, the board is sitting. In fact, at Vizsla Silver, we've got a board meeting today. The board is sitting ready, right? They are ready. They've seen all the technical merits of this project. They understand that we're fully financed, 2x in terms of that financing capacity. It's really they are waiting to get those permits and make that construction decision. The timeline, and we discussed this in the presentation, it puts the permit receival following the statutory timelines from the government in Mexico. It puts that permit receival in the first half of 2026. And so we're guiding the market to the midpoint of next year to have those permits in hand and get cracking on the earthworks and building the mine. That is the risk. Now, it's not a risk in sense of, you'll never get them, but in terms of time value of money, if you get those permits in Q3 of next year, well, now you're delaying it by 3 months. I can tell you when you start looking in the model for Vizsla Royalties, every 6 months adds $5 million, just bottom line to that value, just by the time value of money. And so by pushing that out for Vizsla Royalties every 3 months, you're losing $2.5 million value, right? And so that's the way I like to look at it, is the time value of money. If we continue to push things out, we are incrementally losing. But then, of course, once you're in production, you get the multiples and you gain it all back. But really, that's what it is. It's a delay. Again, the technical aspects, the jurisdictional aspects, the access to capital, all of that continues to be de-risked. Frankly, it's now just receiving those permits. And, given that this is all previously disturbed ground, the social license is secured by Vizsla Silver to operate in the local communities. Again, we do not view it as a matter of if, it's a matter of when. And when is the midpoint of 2026.
Let's talk about valuations here. Currently, what is your consensus price to NAV, and also what gold and silver price assumptions are going into that NAV consensus?
Yeah. So we are trading very well. And right now, we're trading at about 1.4 times price to NAV, which is quite high. In fact, we trade higher multiples than some of our peers with larger market caps, right? Our market cap valuation right now is around 300 million Canadian. And it's been pretty stable there, in and around there for some time, which is great to see. You don't want to see a run up and then just, a spike down. You want to see a plateauing as everybody starts to put pen to paper following the feasibility study. The analysts, we have 3 analysts covering us. One of them is underwater, right? And frankly, that one analyst has been chasing the stock price in terms of his target since initiation, which is unfortunate to see. But sometimes that's how it has to be done when the market sentiment takes over. So we are trading well. The commodity price assumptions, they're various for each one of those groups, but average analyst consensus right now is pretty much in line with what the feasibility pricing was. So $35.50 for silver and $3,100 long-term. These are long-term consensus pricings as they stand today for gold there. So some use discounts. In fact, most of them use discounts. And then they might apply a multiple at the end of the day. So discount to their DCF model, but then applying a NAV multiple because we are a single asset, silver primary royalty. There's, again, and I mentioned this in the presentation, there are 0 tier 1 silver primary royalties held outside of Wheaton, Franco, and Royal. These are multi-billion-dollar plus $10 billion valuation companies. So the big 3 own all of them, right? That does put a bit of a target on us and justifies a premium.
But do you have any idea what your price to NAV would be for Vizsla Royalties, or at least NAV would be, if you say we would use $50 silver, $4,000 gold? So close, slightly below spot prices.
Yeah, I think if you look at Vizsla Silver, and we can just use them as a guide because we do have the feasibility with the sensitivity charts that are in the public domain, whereas Royalties does not have that. We kind of have to rely on the analysts and their commodity price assumptions and their valuations, right, and their methodology to value. Although we can run a DCF, which we do, ours is a bit different, right? In terms of Vizsla Silver, though, when you look at their price sensitivity for the recent feasibility study, just on a NAV basis or an MPV basis, you go from $1.8 billion at those consensus price assumptions I just stated, $35.50 silver, $3,100 gold. And when you go up 50%, closer to spot, call it, like you said, $54 silver. I think you're at $4,600 gold in that scenario. Well, you're a $3.2 billion after-tax NPV, 5. And you are 165% post-tax IRR. These things translate and trickle down directly to royalties. In fact, your listeners can do the math themselves. The back of the envelope math here is 3.2% covering the entire feasibility mine plan. Because you have to remember 3.5 for the 95%, then you got a small component that's 2% at the end of the mine's life. But for simple math, back of the envelope math, 3.2% of annual production goes to Vizsla Royalties. So roughly, and I'll do that math for you guys, roughly it's 550,000 ounces per year of silver equivalent. You can just do that math yourself, 550,000 times whatever price assumptions you want. You don't have to outlay any capital, right? There's no, operating costs associated with this because we're the royalty company. So just do that math. 550,000 ounces times X. And that's your number. Now, you will realize a better number if you do it right, because that time value money, right? You're doing 3.5% over all of those early years. Well, for the majority of all of those early years, it's just owing to the 3.5%. So you're actually going to show better economics on a full model by doing it right, putting the 3.5 up front, and then trickling down with the 2% later on. But for the simple back of the envelope, do the 3.2% times 550,000 ounces per year.
You also have higher production. I mean, the first year I think it's more like 800,000 something ounces.
Well, that's what I'm saying. I'm doing the average back of the envelope just to guide everyone. But of course, when you get into the nuance, you're going to push forward a lot of cash flow by doing that right math, the right arithmetic, and applying those right royalty coverages.
What's the long-term strategy for Vizsla Royalties? It seems like, from speaking with you, that you might acquire some new royalties that's tied to Vizsla Silver, but you don't really have any plan to go out and try to be in competitive processes for other royalties. So could you add some color on how you're thinking there?
Yeah. I think you're right. Right now it's kind of a hurry up and wait scenario. We've reviewed a lot. And we are continuing to review. There are some private assets as well that are on the chunkier side. That takes time. It takes a lot of time, right? And so we are reviewing, certainly, but and I've always said this, we're not going out to Arizona to buy a copper asset. We're not going out to Africa to look for a gold royalty. You know what I mean? We're sticking to our knitting. We're focused on Mexico, Latin America, South America, and when we have the ability to follow Vizsla Silver with a huge balance sheet, it's pretty wise to do so. So we've really hitched our cart to a powerful horse. And we don't want to go out and make a dilutive acquisition just for the sake of making one. We want to be very methodical in what we're doing and create additional value for shareholders. And we continue to do those trade-offs, and the way we see it, Vizsla Silver's Panuco project is going to really create that value.
From Vizsla Royalties' perspective here, I mean, there aren't that many out there. So what royalty and streaming companies could be potential acquirers? And if I say, what's a likely timing? Is it waiting after permits? Is once it's production? If you look at historic transactions.
Yeah, that's a great question. And this is something that we at the board level at Vizsla Royalties are constantly discussing. The opportunity cost of waiting until permits are received is difficult to quantify. You can go and look at examples of royalty companies and what the re-rate was post their flagship asset receiving permits. But unless it's a single asset royalty company, it's pretty tricky, right? Because you've got a portfolio of assets in different jurisdictions, different commodities, different stages. It's very challenging to find that perfect fit that can really point to what the opportunity cost objectively is, right? So that's a task for the board, the special committee that we've got. So we are constantly reviewing that. Now, in terms of who it could be, in terms of a takeout candidate, or a potential acquirer rather, would be the likes of the big three. Those companies that I alluded to in the presentation that could pay over 2 times. I mean, we're trading at 1.4 times, says the analyst today. It's not that far to get to 2 times from where we are. You're talking about a 60% premium to where we're trading right now. That's not out of the realm of possibility for these larger groups, and frankly, a few of the smaller ones that are fastly approaching valuations or portfolios that could rival some of those. Probably not the likes of the Wheaton or the Franco, but certainly of the Royals. And so when we put that hat on, we can talk about the triple flags, the Cisco royalties. But then when we talk about Tether and in making its investment, you saw EMX and Elemental merge, and then we saw Tether, the crypto company, invest heavily into Elemental, essentially using them as the vehicle to then go out and purchase additional royalties. But then we saw them make a nice investment into Versamet, Metalla, and Gold GROY, Gold Royalty, right? And so now Tether's really put its fingers into a lot of pies. We do know that they have a preference for gold, but when you talk about Vizsla Silver and Panuco and Vizsla Royalties exposure, well, it's 50-50. It's silver and gold, slightly more owning to silver, which is important to maintain that silver primary statement. So at the end of the day, it could be a whole host of companies that would be interested. It doesn't matter if you're gold, because we've got gold, or a silver focus, or a diversified metal focus. There's a lot of very big royalty companies and a few smaller ones that the VROY production portfolio could certainly stand to benefit them.
So with that comes my ultimate question. This sort of pertains to this. Where do you envision Vizsla Royalties in 2 years from now?
If it's still around, and that's the question mark, is it still around? If it's still around, I think it will be trading, again, using those, call it 15x to 20x cash flow multiples. And again, if you're doing on average 28, and it will probably be higher by that time. Vizsla Silver is doing a lot of work to continue to convert and expand the known resource and ultimately reserve base, likely with an update to the resource and to that mine plan before they make that production decision. So we could see this royalty, cash flows owing to royalties grow within 2 years, growing that overall cash flows and ultimately that cash flow multiple. So I could see Vizsla Royalties as a double within those 2 years from where it's trading today.